Most investors believe their portfolio is diversified just because they hold a few different stocks. But diversification is not about quantity, it's about protection. A portfolio that looks safe on the surface can still collapse during market volatility if the assets behave the same way. Many investors don't realize that a single market event can wipe out years of gains despite having dozens of positions. The real danger is thinking you're protected when you're not. True diversification requires strategy, awareness, and intentional asset allocation across multiple dimensions. Today, we uncovered the truth about diversification, why most portfolios silently fail, and how you can fix yours before the next downturn hits. By the end of this video, you'll understand the common mistakes and the actionable steps to safeguard and grow your wealth. Understanding this now can save you from significant losses in the future. 1. Why most portfolios are not truly diversified. Most investors unintentionally build portfolios that move in the same direction. They buy multiple stocks from the same sector without realizing how correlated they are. When one falls, they all fall together. What looks like 10 different investments is actually just one type of risk copied 10 times. Many investors assume sector diversification is enough, but correlations during recessions often rise dramatically. Real diversification requires understanding how assets behave, not just how many you own. Without this deeper view, investors face far greater losses during economic shifts. Recognizing this is the first step toward building a resilient portfolio that can withstand volatility. Being aware of these pitfalls allows you to take action before it's too late. 2. The danger of hidden correlation. Two assets can appear totally different but still collapse at the same time. Many investors learn this the hard way during financial crises when their stocks, tech shares, and even crypto dropped simultaneously. This happens because markets often react to the same economic triggers, such as interest rates, inflation, or global events. Hidden correlations create a false sense of security and leave portfolios exposed when conditions change. Even assets in different countries or industries can move together under global stress. Understanding how investments correlate helps you avoid unintended risk. Diversification isn't just about adding more assets. It's about adding assets that respond differently to the same events. Recognizing these connections is the first step toward building a stable portfolio that actually reduces risk. Knowing this helps you plan smarter allocations across markets. 3. Why sector concentration weakens your portfolio. If most of your investments come from one or two industries, your risk is far higher than you think. A tech-heavy portfolio may grow quickly, but one slowdown in innovation can wipe out years of gains. Similarly, overexposure to finance, energy, or real estate ties your wealth to the fate of that single sector. True diversification spreads risk across multiple industries that react differently to market conditions. Many investors overlook the importance of cyclical versus defensive sectors, leaving themselves vulnerable to economic cycles. Even if your sectors are high-performing today, a downturn can erase all your gains. Proper sector diversification balances growth potential with downside protection. Without this balance, even a single negative event can drag your entire portfolio downward. Smart diversification includes analyzing industry trends and adjusting exposure over time. 4. The importance of geographic diversification. Investors often forget that economic trends vary dramatically across countries. A strong market in one region can be completely offset by weakness in another. By spreading investments across global markets, you reduce the impact of localized downturns. Geographic exposure protects your portfolio from currency risks, political changes, and regional recessions. Different countries have varying interest rates, inflation levels, and fiscal policies that affect markets differently. Exposure to multiple economies allows you to capture growth while mitigating risk. Many portfolios fail because investors focus solely on domestic assets. The world economy does not move in one direction, and your portfolio shouldn't either. Diversifying globally also helps reduce dependence on a single central bank or government policy. 5. How asset classes create true stability. Stocks alone cannot provide a balanced foundation. Bonds, commodities, real estate, cash reserves, and even defensive assets play unique roles in stabilizing returns. When stocks fall, other assets often rise or stay steady, reducing overall volatility. A portfolio built across multiple asset classes absorbs shocks more effectively and recovers faster. Each class behaves differently under economic stress, providing a buffer against unexpected events. Commodities can hedge inflation, bonds provide income stability, and cash gives liquidity for opportunities. Diversification across asset classes ensures growth while protecting against catastrophic losses. Without this mix, your portfolio becomes vulnerable to every shift in the stock market. Including alternative assets can further reduce correlation and increase long-term stability. 6. The role of risk levels in diversification. Diversification is not just about variety, it's about balancing risk. High-risk assets can generate strong returns, but they should be offset with stable, lower-risk options. This balance keeps your portfolio from swinging wildly during volatility. Understanding your personal risk tolerance is critical because a stable strategy reduces emotional decision-making. Investors often take too much risk in one area while underexposing themselves to safety assets. Balancing growth and stability ensures that one market shock won't derail your entire plan. Risk-adjusted diversification allows you to stay invested through cycles with confidence. Without managing risk levels, diversification becomes incomplete and ineffective. Periodic reviews of risk exposure ensure your portfolio evolves with market condition. 7. How to know if your portfolio is overexposed. If your investments depend on a single sector, region, or trend, you may be overexposed without realizing it. Sudden market changes often reveal this weakness when multiple investments start falling at once. Evaluating where most of your returns come from helps identify dangerous concentrations. Tracking how your assets move during market swings also highlights unhealthy correlations. Many investors only discover overexposure after experiencing a significant drawdown. Conducting regular portfolio reviews prevents surprises and keeps your risk in check. Rebalancing allows you to shift allocations toward underrepresented areas. Recognizing these patterns allows you to adjust your strategy before problems escalate. Monitoring exposure over time helps you maintain long-term stability. 8. How to build a fully diversified portfolio. Start by spreading your investments across multiple sectors and industries. Add global exposure to reduce dependence on your local economy. Include different asset classes such as bonds, real estate, commodities, and cash for balance. Rebalance regularly to keep your allocations aligned with your goals. Diversified portfolios also require attention to risk levels and correlation between assets. Consider adding alternative investments to further protect against traditional market downturns. Setting clear allocation targets ensures consistency over time and prevents emotional decisions. When built correctly, diversification becomes your strongest defense and your most reliable growth tool. A diversified portfolio adapts to changing markets while maintaining long-term growth potential. If this guide helped you understand why most portfolios are not as safe as they appear, now is the moment to take control of your financial future. A truly diversified strategy protects your wealth, reduces stress, and gives you confidence during every market cycle. Take a few minutes today to evaluate your current portfolio and identify where the weaknesses lie. Start implementing these diversification steps gradually and consistently to safeguard your investments. Review your allocations monthly or quarterly to ensure ongoing balance and resilience. And if you want more insights like this, support the channel by liking the video, subscribing, and sharing it with someone who needs to fix their investment strategy. The right decisions today can create stability, growth, and long-term financial freedom. Diversification isn't optional. It's the foundation of lasting wealth. By acting now, you turn knowledge into tangible protection and opportunity.